Good morning. I'm Peter Milios from the Finance News Network. The Nasdaq Composite fell on Wednesday for a third straight losing session as investors shifted away from growth stocks amid signs that the US economy is weakening. The moves came as traders mulled over the latest ADP private payrolls report, which showed slowing job growth in March. That followed Tuesday's job openings report that suggested the Federal Reserve's efforts to cool the labour market might finally be having an effect. In February, the number of available positions fell below 10 million for the first time in nearly 2 years. Overall, the tech-heavy index sank 1.1%, while the broad-based S&P 500 dipped 0.3%. The Dow Jones Industrial Average added about 0.2%, bolstered by an outperformance by healthcare stocks. High-growth tech stocks were under pressure overnight, with Scalia and CrowdStrike falling 8% and 7% respectively. Chip stocks were also under pressure, with Advanced Micro Devices falling 3%. The defensive tilt of the market helped healthcare stocks outperform, boosting the Dow. Johnson & Johnson shares rose 3.5% after the pharmaceutical company said Tuesday it would pay $8.9 billion over the next 25 years to settle claims that its talc products cause cancer. Utility stocks also outperformed, with the Utility Select Sector SPDR fund, which tracks the S&P 500 utility sector, closing higher by over 2%. US Treasury yields fell overnight, but the potential for further rate hikes from the central bank is contributing to market volatility. New Zealand's central bank yesterday hiked rates by 50 basis points, noting that inflation was too high and persistent. In commodity news, lithium prices, which rose drastically over the past 2 years and hurt consumers and automakers with rising battery costs, are now reversing and dropping more than 30% this year. This drop is due to a slowing demand for electric vehicles in China and cautious traders in volatile markets. The lower prices for lithium and other battery metals will help provide some relief for automakers and consumers after commodities helped lift battery prices about 7% last year, according to data provider Bloomberg NEF. It typically takes months for moves in metal prices to ripple through to car costs because buyers negotiate long-term price contracts. And the Australian government anticipates cooling in the price of iron ore over the next 5 years due to slower demand growth and increasing supply. Note that the iron ore prices rebounded in recent months because of partial recovery in China's steel production as the country reopens following the end of its zero-COVID policy. However, expects a mild decline in total steel production over the next 5 years, which should lead to a softer rate of growth in global iron ore demand. Overall, overnight S&P 500 sectors closed mostly lower. As previously mentioned, utilities outperformed, whilst consumer discretionary was the biggest laggard. The SPI futures are pointing to a 0.1% fall. Have a good day and have a happy and safe Easter.